Good morning, this is Teddy Kekstadt from Forex Trading Unlocked, and this morning we have a Forex market breakdown for you. And let's first get through a little accounting here. And here is our disclaimer from Forex Trading Unlocked, just basically letting you know that this webinar is for illustrative purposes. And here we have our Nadex disclaimer as well, our sponsor for this webinar today. And same thing is just letting you know that this is for illustrative purposes and what have you. So you can take a look at that really quick. And here, let's start talking about what we're going to have on the menu today. So first, let's take a look at our economic calendar. Today we have basically this week, all the numbers that are coming out are very US dollar dominant. First, we have wholesale inventories that's going to be released today. We also have jobless claims and CPI, which is coming out tomorrow. Both the jobless claims, I don't think is so much the big number to watch. The CPI, I think, is the one to really keep an eye on. And then following through on Friday, we have the PPI. So these are all numbers that are very US dollar related. They're also interest rate related, which is a currency component. So any skew in expectations on, especially I think the CPI and the PPI, I think would start to definitely have a lot of end of the week jitters in the currency market as well as other markets. So it's summertime and the markets aren't completely asleep, but coming into a Friday eventually when it comes to the PPI number, usually the markets start to die after that number. So I don't expect any big changes in any of them. Jobless claims might be the one number that may have a little bit of out of expectations, but even still, I don't think it's going to have very much of a reaction. The big question is the US dollar starting to weaken? It's been trending against all the major currencies for a long time. The US dollar has been a bull. Is it time for a correction? Well, we could use one. It would be not out of the realm of possibility, or it wouldn't be necessarily a bad thing either. Markets don't trend in one line. Today, we also have the FOMC Powell's minute, Powell will be speaking for the FOMC minutes, and I think that it'll be interesting to hear not just what they spoke about from the FOMC meeting, but also the take on the rumblings as far as is a currency war going to begin. There's been some pressures and at the higher levels in the U.S. government leaning towards possibly engaging in actions by the Fed to start to devalue the US dollar. What means would they use for this? It is anybody's guess. So first, let's look at one of our major currencies against the US dollar. We have the Euro US dollar chart up here. So let's just say now the Euro US dollar has been trading in a very, very tight range for the last 4 to 6 months. And you can even see here we have right now is pretty much a current snapshot of where the market's trading, right above $1.12. And we have these two major pivots here, one at $1.1264 and another one at $1.1181. That's not a very big range. It's less than a full dollar there. So right now, the market is winding its coil and has been. It has not been trading in very big. But should we get a spark of a currency war, I think you could start to see some really big moves. And if that would be the case, that would make the Euro US dollar a bull. So now, is that going to happen right off the bat? Well, that remains to be seen, and we have to see what kind of actions happen. Right now, there's just rumblings. And why would a currency war be something that the U.S. would like to maybe, at least on some level, engage? Well, mainly to increase the exports. In theory, economic theory would mean that exports in the U.S. would increase, driving up the profits and the volume of manufacturing and services coming out of the United States. Also, it would mean that the different currency relations, if there was a big dollar shift, that would change a lot of things as far as how profits are made globally and versus Asia and the EU and other countries such as that. And we'll get into that as we go through these major currencies. So let's just say that this currency war topic rumbling starts to become something that begins to manifest. So that would mean that we most likely would have a breakout of this key pivot level here at $1.1264. Right now on the daily, we have, the market's been basically in a sideways trade. However, over the past month and a half, it's been obviously in a bullish trade. Now it looks like it's been pretty choppy, but then once again, remember the range we talked about. It's not trading in a very big range. I mean, the low from the end of May up until just before July, at the end of June, this high is up at 114. You're looking at a full $3 move at most. So that's not a very big range to encompass a month and a half's worth of trading. So right now we're not looking for any major moves when it comes to this currency, which is one of the biggest currencies versus the dollar. So that's something to pay attention to. But now let's say currency war or not, US dollar correction begins just because of profit taking. Well, that would actually coincide with this current uptrend in the euro US dollar, meaning that the short-term trend, which is bearish and is heading into this target trading range, where I think that this is where we're going to see the market kind of gravitate to over the next few sessions into the next week and a half. I don't see any real major reason to see the euro US dollar fall below this 111.81 area, which is a critical support level. The main reason is that short term, the market's in a bearish phase, but it looks like it's starting to try and find some buying pressure that will lift the market back up, and the trend is your friend. That being said, we should expect that most likely the euro US dollar is going to start to gravitate towards higher levels. Now, should it take out this 111.81 level, that would take out this last higher move low. So on a basic technical analysis, as far as direction, that would mean taking out that last low, we would have a lower move low after a higher move high, which would indicate a potential change in trend or neutral trade to develop. Once again, I think that's very likely. That neutral trade would then settle into this trading range here, which doesn't give you very much to play for. So for whether you are an outright position trader in the Forex markets for the euro US dollar, I would look for bullish breakouts above 112 and bearish breakouts below 111.81 to confirm any real type of momentum to get any type of move. Just because if you look at it, the ranges have been very tight. Last week, except for Monday after the G20 summit, the ranges in the euro US dollar, I mean, have been in upwards, I mean, as small as 40 cents, which is very tight. I mean, it's like as if it was Christmas Eve or something. Even for summertime, you just don't get that kind of tight trading, even this, you just don't. It's not very normal at all. So especially, it's one thing for it to happen on one day, but for it to occur on multiple days in the week, that just really doesn't, it's not normal trading. So you can see an example of here of this last major high here, where it made a high and then 1, 2, 3 days, we were inside that range that day, which was only a 50-cent range to begin with on that day. It's very tight trading, and that's something to consider for whether you are bullish or bearish this market, is that it is summertime, have irrational expectations. That's why I think you should look for a signal and look for key breakout points right now. Otherwise, you're looking, if let's say the market does stay in this target range, your profit potentials here are very tight if you're trading directionally. Now, if you're an options trader and you have different types of spread types of positions, that's a different story where you can trade against these levels. And especially for that kind of a trader, if you're a range trade type of trader and not a swing trader, this might be an environment right now over the next week or so to capitalize on that. So with that being said, let's move on to the next slide for our next currency. So now we have the British pound US dollar, our second major currency against the dollar. Now, as you can see, this is obviously in a bear trend. The British pound US dollar has been pretty much a free fall for multiple reasons. Brexit, soft or hard, who knows where that's going to go, is definitely one of the heavy weights that has been knocking the pound down. But then there's also other issues because of the trade talks between the UK and the EU for moving forward with Brexit. And right now, things haven't necessarily impacted the trade. It's just the rumblings of what will happen once they finally get across that final bridge. So that being said, you have to, the momentum is to the downside. Now, as far as downside levels, targeting that's a really rough call because this market is you don't want to try and catch a falling knife. And let's just say that we do have a short-term correction in the dollar. What would that mean? So dollar weakness would mean pound strength. But if the dollar is just going to be in a corrective mode, which, like I said, currency war aside, it's not overdue, but it would be not be out of the realm of possibility to have a little short-term correction for a week or two, just for profit taking and just to let the things balance out before the trend continues higher for the dollar. Perspective for which currency we're talking. So let's just take a look at this. We have an upside bullish target range. So right now, am I saying we have any buy signals? By no means, not at all. But if we do start to see, let's say, a turn in dollar and dollar weakness come out of, let's say, after the Fed minutes come out today, and then those economic numbers we come out, if they come out expected or radically outside of expectations that would be negative the dollar, well, that would be positive the pound, and then we would most likely see a challenge of first this key pivot level. You can see a directional arrow right now. So yes, today's trading is just a little bit lower than where it settled yesterday. It hasn't made a newer move low on a daily basis yet today. This chart, unless it just happened as this webinar is going on, because this chart's pretty fresh. So with that being said, right now it looks like it's digesting this recent slide. I mean, look at all this. It's all red bars here. The market's been trading lower, not just for the past couple months, but the past 2.5 weeks, pretty much it's been a negative trade. Now, this key pivot level here would be where this one low is right here. So that's this is also a weekly number too that comes in really close to it. So we chose this level here for our key pivot level as far as downside direction. I think that if you are a short-term intraday trader, this would be a level, this $1.2504 would be pretty much your risk level, I think, for weak shorts, just because the trend, you don't want to sell it in the hole either. And right now, this pound dollar trade, a short-term correction just for a couple days or a week and a half would be a normal thing for it to do. So let's look at this level. Let's say we get a rally above $1.2504. What does that give us? Not a lot. You can see that this market, although in a bear trend, it's been basically setting up a range trade since the end of May. June, it's at the upper parameter, lower parameter. Now we had this recent higher move high, which was a bullish indication, but now we have a lower move low. So that means there's indecisiveness on the daily chart in the intermediate to short term. Obviously, the overall trend is bearish. The pressure is against the pound and dollar strength. But let's say we do have a dollar correction that starts to hit. It's very likely that the pound would have a nice reaction and that it would be a short-term time for profit taking. I mean, the bears may want to still keep this trend going down for the rest of the year, but right now the shorts, I'm sure, wouldn't mind taking some profits and having the opportunity to sell this market again back up in where we have this upside bullish target trading range. So that being said, I think that you've got to use this $1.2504 as your risk level for bears, and for bulls. I would definitely not try to buy into this break right now. I would definitely use that level, a rally above that, especially a close above that. I mean, right now you can see we have this blue line, which is our downward sloping resistance. So even if we get a pop above this first pivot line and a challenge of this next one here, the purple dash line, before we get into our upside bullish target range, we have to cross this downward sloping resistance. And this is where I think you will get a key indication of what's going to happen with the short-term trend over the next week, month to 2 months with the pound dollar. A rally above here and a breach of this blue downward sloping resistance line would be a signal that the pound dollar is in a neutral to higher posture, for one. But it also means that the longer term bear trend is probably on hold, meaning that a sideways trade, big wide range trade may develop. We are at midsummer, and which if we do get into this, let's say we breach this area by July, end of July into August, and we settle into here and we don't get out of it. And this is where I think the range would stay here. This upper number here, this upper pivot is $1.2761. Only a rally above there would really start to be that would be where this is really a bottoming basing area, and you'd probably start to see a rally that looks like this break that happened here in May, where it's really, really radical, and you get a move that would shoot the pound back up towards this 129.5, 130 area. Now, is that really likely? I don't think so. I think the only thing that would really indicate something like that would be, besides some incredible economic numbers coming out of the UK and a soft Brexit happening sooner than later, or on track to occur, I don't think you're going to see a rally that would be that big over the next month and a half to 2 months. What I do think is that, like I said, with these levels here, if we start to get a rally above here, we could start to gravitate, and then this downward sloping resistance is our major number to watch. So that being said, be careful being a bull, look for signals, and being a bear, I would be careful of profit taking now. So if you're short, work it and keep your stops tight. I would say that if you have definitely caught a big part of this move and the market gets above this 125.04 area, maybe look to kind of take off some profits and see what happens and digest the move, because you don't, if it really does get, like I said, breaches this downward sloping resistance area, then it has a good chance of settling into this target range. So if you're short and you didn't take profits, then you're looking at it trading in a range like this here at the beginning of June and going into the beginning of July, which means that it's really tight. And then what do you have to look for afterwards? You're looking at a range that would probably limit itself to this upside breakout level here and this upside bullish target range lid right here. So trading below the 125.04 keeps the bearish trend intact, but don't try to catch a falling knife, you know. So look for the signals and the points to occur. And now let's take a look at the US dollar Swiss. This market has obviously been in a short-term rally, and it bounced really strong off this 97-cent level all the way up to above 99 cents, and it was targeting parity. This market seems to be always trying to make a run for parity. Now it's been in a bear market in a big way for the last couple months, and we definitely had this radical rejection here of parity right here, which that's our upside breakout level. So short-term, we're using yesterday's high to just give a little bit of resistance, and then we have this lower line that's rising. That's our steep rising support line. So I think that the momentum of this rally is going to start to run out of gas. Short term, yesterday's high, we're just using that as a resistance level. It could easily be breached today and then pop above that. But right now we're using that as short term because it kind of goes in with the channeling trend lower here of these highs. So if this is a lower move high, the trend is your friend, we're looking at most likely the US dollar Swiss would start to fall into this target area here. Now here's where we have a contrast in terms. Remember we were talking about what if there is a dollar correction that is starting to form, whether it's technical or if it's fundamentally driven because of potential actions by the Fed, which none's going to happen today. But like I said, if after the or during the minutes, if there's any type of leaning towards doing it, taking any measures that could weaken the dollar, this would be an indication that, yeah, it's on the plate and the Fed will be probably working towards that as we head into the fall over the next couple months. So that being said, dollar weakness would not make sense here because right now the US dollar strength has been bringing the US dollar Swiss up towards parity. So dollar weakness would have it coming into this target trading range here. So this is right now where we're looking for, okay, the market is in a bear trend. We would look right now for where it's at. This is a good resistance area to start to look for some shorting opportunities. For bulls, I think that the only, right now you have, this current short-term trend is probably exhausted. At the very least, I see it coming down to take a test of this 98.94 dashed line, which is right at the above of our top part of our target trading range. It also comes down into this area here where we have this upward sloping trend line. If the market bounces here and can contain itself into this trading area here, then I think you can start to build a base, which then keeps the continuation of this shorter term trend to the upside, which right now is a corrective move on the overall bear trend. Like I said, parity is a psychological number. It always seems to want to gravitate either from a break or from a rally towards this number. So that being said, if there's enough short-term buying pressure to get a run above this yesterday's high, I think you can see over the next couple of sessions a shot at taking this current upside breakout level out. Now, that would mean US dollar strength is prevailing, which goes against our theory of, is there possibly a US dollar correction occurring? So I would say that in that case, if we get a US dollar Swiss rally, obviously US dollar strength is prevailing. However, the US dollar Swiss is typically a good heads up indicator of what the dollar is going to do against the other majors, especially the euro and the British pound. So if we have a shift where, let's say that the US dollar Swiss does fall below this 98.94 and starts to trade around into this at these lower pivots at 98.55 down to 98.17, this would be a nice little corrective digestive area. So short-term correction dollar, which would mean obviously weakness in the US dollar Swiss, and that would coincide with our theory of potential breaks being put on the US dollar rally. And this is not an overall trend shift either that we're talking about. We're just looking for a short-term corrective opportunity that besides the technicals that are in place in the market, we have some fundamentals coming out just because of the speak and the pressures that are coming out of Washington to start to do some things to manipulate the dollar, basically, because other countries are being accused of doing so, which we know is definitely a fact. And China and a couple other countries have been definitely trying to devalue their currencies to help to float their economy, which is what all countries do. Is it a good thing? Is it a bad thing? If that's what you rely on, long term, it's a bad thing. But short term, it does have its there's merits. You know, it's kind of funny. 20 years ago, you couldn't talk about trying to defend the dollar if you try, no matter what. You're like, when is the Fed going to do something to protect the dollar? You know, at one point, you know, the euro was trading up around $1.30, $1.40. Now it's trading at $1.12. And that was without us trying to protect the dollar. And people then were saying, we got to protect the dollar. We got to protect the dollar. Now all of a sudden it's no, we don't. We need to let the dollar weaken. So I think that it's just short-term currency war maneuver. It's not a long-term outlook for the dollar that these rumblings are coming from. I think it's just a short-term combative thing because it's another way of also balancing out the tariff wars. So that's a whole nother topic for a whole nother day. We don't want to get into that on this webinar. That would be a whole nother, that would take an hour at least. So short term, let's look at this once again. I think that you have a corrective phase that's going to begin, which follows this trend. The trend is your friend. So bears, I think you have a really good opportunity to slowly see the US dollar Swiss come down towards this target trading range. Now the key is, does it hold this 98.55 level? If it just comes into this target trading range and just kind of goes halfway and dips in there and then pops out, that's a good indication that we have a basing situation happening for another rally, which I think then, if you have a basing situation where it doesn't falter and take out these lower higher move low area, which is in between these two pivots, that would be a very strong situation, meaning dollar strength, and the dollar Swiss most likely is going to make a run for parity. Now, challenging parity, even if it blows through it and gets up to $1.01, that would mean from where it's coming down from 97, that would be an extreme rally, just counter trend. And I think that for sure it would definitely run out of gas and then gravitate back to around this parity level. And that would be where I think we have a swing point developing. At least this would be it coming up over the next couple months. And we would have to see, like I said, short term, whether we get up to that parity level. And then that will be our indication for the US dollar for strength and weakness ahead of the other ones. So if this market does head into this target trading range and fails, that's where we have to see dollar weakness is definitely coming into play, which then would affect the euro, the pound, and other major currency crosses against the dollar. And then I think that would definitely indicate that the US dollar is set for a corrective phase, which in the short term, even if it lasted for a few months, even 6 months, a dollar correction, a dollar bear for 6 months doesn't mean any real major economic paradigm shift in the currency markets. It's just something that's kind of long overdue. And it would have to see, even if it did slide for 3 to 6 months, it would be the extent of the correction would be the thing that would be the main variable to watch as that would unfold. But we're looking at the short term. So short term, once again, I think the trend is your friend. Bulls, unless you get a breakout above or a breach of yesterday's high, then I think you've got a shot at making a play at parity. But I think your upside target for a bullish move, you're not going to get much follow through. So I think parity would be your target level. And then for options traders and range traders, if you're not a swing trader, then I would definitely consider using this first pivot here at 98.94, and then also this parity pivot as your major range to use for different levels. So that being said, let's move on to our next major Forex cross, the US dollar Japanese yen. So the US dollar Japanese yen has been in a short-term corrective phase to the upside, just like the US dollar Swiss. And now it's coming up against a big pivot as well. You can see that the slope of the last few weeks of trading has been very, very steep. Now this has been an ugly trade. If you look at this range area of the month of June, except for when it slipped down to make this lower move low, then it came back into this area. It's in a very tight range as well. The currencies have, because this has been so tight for so long, it looks like there's good volatility and good swing trade opportunities. But if you put this out onto a weekly and monthly scenario, look and see that the volatility is really not that severe, meaning that the opportunities are not there. So that being said, I think that short term, the trend is obviously higher, and it's a bullish trend. Intermediate, it's a range trade. So obviously long term, we're looking at making potentially lower move highs right now because of where it's at. And that means that we're probably going to see a sideways scenario coming into play right now. This pivot right here at 109.025, I think is your critical directional pivot. A breach of this would mean that this steep sloping bullish rally that we have going on, the momentum is there. And I think you can definitely see it get back up towards this 110 area. You can see there was a bulk of trading back in May that had occurred over here. Is that likely? That would mean US dollar strength is coming into play. And this weakness that we were talking about, those variables are obviously not occurring. But if they do, and it does fall in line over the next couple of days, and especially, like I said, we're starting with the FOMC meeting, or not meeting, minutes, then the bulls would start to run out of gas here. This 109, this critical directional pivot could be some very good resistance for the next few sessions to maybe even a week and a half. That being said, going with the theory of US dollar weakness, that would put the US dollar yen in a situation where it would start to come down to this challenge and test this upper sloping support line. And that also places it into our target trading range, which is between this 107.808 up to 109.025. That trading range is not too tight, but not too wide either. I think it's very likely that if, like they said, we get a dollar correction, this is pretty much where you're going to see the market gravitate to. And as you can see, over the last month and a half, the bulk of trading has occurred above 107.808 up to this 109 area. Now, it's an ugly trade here. The past week and a half has been some pretty definable up or down trading days and swing trade opportunities. But if you look at how end of May into the end of June, it was a very ugly trade. So I think that if you are an outright directional trader, be careful for bulls. I would say only if you get a breach and a rally above this 109 here area, then you can probably see momentum come in to ride the wave higher. Otherwise, I think even if we have a short-term corrective move, it's just setting up for a range trade here for the US dollar yen for the next couple of weeks as we head towards August. Only a failure from 107.808, folks, I think would change that, because then you have this low here. See how we have this low? We have the two lows that built our upward sloping support line. This low here is a higher move low. We had first this initial bottom here. We had a higher move, or a lower move high, then we had a higher move low, and now we've made a higher move high that's taken out not just this high, but this high here. Even that, though that's a very bullish sign, it's, like I said, coming into the point where we're looking at potential US dollar weakness. And especially if the US dollar weakness falls against the Swiss and the pound and the euro, most likely the yen is going to see a little bit of a reaction because it's hitting the major basket of currencies. We could talk about some other crosses out there that have been completely divergent of the US dollar bull, but that's for another webinar. So right now we're focusing on these majors. And for your levels, so for swing traders, I think that especially for a bear, until you take out this downside breakout level, there's nothing to really look at for the downside. I'd be very careful because the trend is your friend. Short term, we're in a bullish market. Overall, obviously bearish for longer term, but intermediate, it's neutral. So neutral to higher is the strength, but so there's no reason to be a seller until down here. And this would also be for your bulls. I would not want to be short below here anymore. If you are buying into this range right now, if you're already long, your risk level is low here, I think for sure. If you don't use this pivot, this would be critical for you because any trading that comes down into that area is no longer in a neutral phase. It means that the overall trend is a bear, and that also would mean that this current rally that we're in is just a corrective move higher. It's not the beginning of a turn in the market or a bullish trend, or even a neutral to higher trend. So right now, are we looking at a scenario where we could have, you know, the US dollar weakness occur and really take a big slice out of this trend and go through our target area, take out this pivot, and then, you know, look for newer move lows below 107 heading into August? That would mean US dollar weakness is really coming into the marketplace. I don't see that happening. So I think that the reality is, to the downside, is there going to be any major overzealous trend opportunities over the next couple of days into the next couple of weeks? Probably not. I think you do have a good short-term, low-risk selling opportunity using this critical directional pivot here. So for options traders and spread traders, you have opportunities to trade against this level right here. And then also the breaks, even on a slide, looking for this to be the extreme, this lower 107 area. So most likely a containment of this target trading range over the next week and a half to actually possibly going into the end of August into the beginning of September. Only a rally and sustained trade above this 109 pivot really would change the scenario. And even still, that means that the US dollar correction phase that we were talking about is not in play. So with that being said, we're going to review it really quick. We talked about there's the FOMC minutes that are coming out. So if this US dollar, if there is a currency war that does start to get sparked, or even if it's just time for a US dollar correction, then you can start to be a bull for the euro US dollar, also for the British pound US dollar. That would be a good scenario for a rally and for the bulls to take charge. At least for the next couple sessions into the next couple of weeks. For the US dollar JPY, that's the big, this is tough. Like I said, this is probably going to be in a target trading range regardless of what happens with the US dollar. But, you know, if the dog wags the tail and what have you, US dollar weakness would at least give the bears and the US dollar yen a good shot. The US dollar Swiss, same situation. We're looking at where the bears are probably going to get a short-term run for the money, you know, and have a chance to make some profits. And like I said, that would go with our scenario, the yen being the one sideways trade. But then for all these, remember, we're looking and talking about, even if there is a long-term currency war that could change the trend in the dollar for months at a time. Right now, we're just looking for a short-term few sessions into a few weeks to develop, just because it coincides. So whether it's fundamentally occurring or technically occurring, now would be a good time for the US dollar to show some weakness and to get a bounce in these other currencies. So is the pound really collapsing? I don't know. It could be weakness. We'll see. The euro US dollar bears, I don't know. I think that they're the indicator. If they fall apart and the bulls take control, then we know that the US dollar weakness is occurring. So that being said, do your homework, look at the markets, weigh your potential trades, and have rational expectations, stay the course. And when we showed you those, talked about those levels and those currencies, I think those are very solid for the next few sessions into the next couple of weeks. But like I said, don't look for too much opportunity as far as major trend breakouts. I think it's a summertime trade, and those these markets have been trading for the past half a year in a kind of a tight range, especially with the euro US dollar. So use your risk parameters properly and think about that before you take the trade. Sometimes you don't need it. If the risk reward level is not there and appropriate, don't take it, don't force the trade. Once again, I'm Teddy Kekstadt from Forex Trading Unlocked. You can find me all the time at www.forex-trading-unlocked.com. You can follow us on Twitch, StockTwits, and LinkedIn. Please like, follow, and share if you look at our content. And also, the 3-year anniversary of a book I wrote, High Probable Japanese Candlestick Patterns, is available on Amazon on paperback and Kindle. And if you're an Amazon Prime member, you also can just read it by the pages whenever you want. So, and if you want to know what the book's about, it'll help you utilize the best buy and sell patterns used for over 400 years to give yourself a competitive edge against the markets. Help you in the Forex markets. Lots of opportunities on a daily, weekly, and monthly basis. Read the book and find out more about it. With that, that's the end. Thank you very much from Forex Trading Unlocked and from the Nadex. We appreciate your time.